Welcome back to another episode of MoneyScript Monday. My name is Andrew Keene, and today I'm going to be talking to you about how index loans work, how they operate, and why it's such a powerful feature, and how we are able to become our own bank inside these contracts, similar to how the wealthy leverage and utilize positive arbitrage. Now, when we take a look at structuring a policy for maximum efficiency and maximum cash flow, there are three different phases that we want to look at. Typically, most of the emphasis is on the first two, which is your contribution and your accumulation phase. Now, in these stages, you overfund up to the non-MET guidelines and you earn a decent return over time. Now, the third phase, which is the distribution phase, is something that is generally less concerning for most people, but it should be at the forefront of your mind if you're wanting cash flow in retirement. How we are able to access those dollars in a favorable manner is the question. So I've got 5 different ways that we're able to do that inside of these contracts. The first way we do it is through a standard loan. So essentially, this is a loan that you're taking out in the first 1 to 10 years. Now, this can end up costing you a 1% net cost, but it can still be much cheaper than borrowing money from a third party, such as a bank or a credit card. And it gives your money the opportunity to start growing while you're using it. And with compounding interest, the sooner your money starts, the more money you're going to have in the end. Now, a preferred loan is where you're taking out a loan after year 11. It's essentially a 0% net cost. Now, both of these are very conservative in nature, and it's possible to have some missed opportunity costs on the back end. And I'll explain why here in a minute. Next, we have withdrawals. You're going to return your cost basis first. This is going to reduce your account value dollar for dollar. And again, you could be losing some opportunity cost on the backside. Next, we have a full surrender. Now, of course, if you need to walk away from your policy, you can. There may be some tax implications. You could be responsible for paying tax on any interest that you earn inside the contract above the basis. But again, if you need the money, it's there. You can absolutely walk away. And then lastly, we have index loans. Now, index loans can be very lucrative because you're able to take out a loan, have that loan be charged a certain percentage, and then your money inside the policy still continues to grow uninterrupted compounding returns. Now, we do this legally by utilizing and taking advantage of 3 sections inside the Internal Revenue Code. Section 101 talks about how we're able to move or transfer our death benefit to our heirs tax-free. Section 72E talks about how we are able to grow our assets on a tax-deferred basis. And Section 7702 allows us to access those dollars tax-free during our lifetime. Now, like I mentioned before, we're able to be our own bank inside of this contract. We're able to do that through the view of an indexed loan. But before we talk about that, do you understand how banks make money? Well, it's very, very simple. You deposit money into a bank. They give you next to nothing. Then they're going to loan out this money or leverage that money and charge someone else to use your money. The question is, how can you replicate that? And how can you mirror that revenue stream inside of your IUL contract? I've got an example and I'm going to show you how it works. So let's say you've built up $100,000 inside your cash value and you want to take out a $10,000 loan. Now again, cash value inside these contracts are tied to an external index just as the S&P 500, PIMCO, NASDAQ, and some IULs do have a fixed account. Now in this particular situation, we're able to earn up to the cap rate of 16%. And then, of course, IULs have a 0% floor, meaning that they don't lose any money in down years, such as 2008 or 2009. So let's pretend for a minute you build up $100,000 inside your cash value and you want to take out a $10,000 loan. Now, again, your cash value inside these contracts are tied to an external link, such as the S&P 500 or the PIMCO or NASDAQ, and you're able to earn up to a cap of 16% in this scenario. And of course, inside of an IUL, the floor is 0%, so you never lose money inside of an IUL. Now, in the long run, such as 30, 40-year time period, you're going to average about 6.5 to 7% return. And the very important part of it, you never pay any taxes on those returns. So it'd be like earning 9 or 10% or 11% inside of a taxable account. And to be conservative for this particular case, we're going to assume a 6.5% rate of return. Now here's how this works. So you want to access the $10,000. You're going to borrow money from the life insurance company, not from your policy. Remember, your money stays inside the policy and continues to grow uninterrupted. So in this situation, the insurance company is going to charge you 5% on that $10,000. So as you can see, we've got a $10,500 loan balance that is now separate from our policy. Now our money stays inside the policy and continues to grow at 6.5%. Essentially, we're able to create a positive arbitrage. So in this situation, if we're being charged 5% and we're earning 6.5%, we just created a spread in our favor of 1.5%. Now, what if your policy is growing at 12% or 16% and you're only being charged 5%? That's a pretty good profit, a good tax-free profit for doing nothing except holding your money inside of an IUL. Now, there are years where you won't earn 6.5%. There are years where you'll earn more, you'll earn 0. And of course, the larger the spread, the more you're going to benefit. This is a lucrative way to borrow money long term. If we're able to average 6.5%. As you can see here, we're earning 6.5% on both of these accounts. We're being charged 5%. Now that interest that we're being charged can accrue up, and we do have the option of paying off the loan. But again, one of the benefits of these contracts is not having to worry about paying off the interest that we're being charged. Essentially, again, that's our policy's collateral for the loan balance. So when we do expire in the future, your beneficiaries will collect the net amount after the loan balance is paid off. Now, I always recommend paying off the loan. The more money you put in, the more tax-free income you'll be able to pull out throughout your lifetime. So why wouldn't you want to maximize this account? Now, we talked about 5 different ways to access cash value inside of a life insurance policy. We talked about the 3 different sections of the Internal Revenue Code that allows us to take advantage of these policies. I want you to reach out to me and let's get this thing going. Let's start your own bank and let's create some tax-free wealth that is not subject to the stock market. Give me a call. Thank you.